Thanks for joining me here. This is our first presentation of the new year, so hope you're having a happy new year. We've got a lot of material to cover, so we're going to get the show on the road, even though I know I can see people still joining as I speak. But we'll go ahead and get started on time. We've got a lot of material to cover. We're going to look at automated options trading. You can trade these professional strategies without screen watching and having to basically stay in front of your computer all day. So we have these one-touch responsive trade alerts. We're going to look at a demo of that. We're going to look at option spreads and how they work. We're going to use some automation to help us along the way as we manage our risk and our profit. And we're also going to tell you about how we can help you not only with technology, but with personal touch in terms of coaching. Do take a moment and look at the risk disclosure before we get started. A lot of material and words there, so take a screenshot if you want to read all those details. The main thing is that you should be using risk capital when trading, and past performance is never a guarantee of future results. I should also add, be sure to use the chat and questions if you have any comments or questions along the way, and I'll get to those as I can. Okay, a little bit about AltaVest. We've been doing this since 1997 as a registered introducing brokerage firm. We've developed our own technology for trading. We're going to demo that for you here in just a second, trading tens of millions of futures and options contracts over the years. That's a picture actually I took on the floor of the, I think that was the Coffee Sugar Cocoa Exchange. A little blurry, but I kind of still like it, very colorful. And we're registered with the CFTC. We're members of the NFA. So like I said, we've been doing this a long time. So we're regulated and registered. And I am Eric Gebhard. I have my BS in Business Administration from the University of Southern California. I'm a co-founder of AltaVest. And I had some securities licenses in the past for mutual funds, annuities, insurance, and I currently have my Series 3, which is the Commodity Futures license, and the Series 65, and that's for registered investment advisors. And you may have seen us in the past on some of our other presentations online or even in person, some of the other venues that we participate in during the year, whether it's digital or live in person. We often get quoted in various financial periodicals. Here's Market Watch just the other week asking us about our thoughts on gold and silver. And here's a quote from a business partner here, co-founder Mike Armbruster. But if you've seen us in the past, it may be where you've seen us. And if not, and you don't know who we are, well, we're glad you found us and hope you enjoy today's presentation. So let's look at the top 3 trading barriers. And I think you can relate to all these. And as we go through these, you might think, I don't know, maybe chime in the chat there. Tell me which one you have the most pain with. So the first would be information overload. I think you can just call that noise and conflicting information and opinions and just an overwhelming a lot of clickbait narratives, information overload. It hinders our decision making. I think we can all agree on that. Just a lot of sources of material, especially obviously online. The information can often be complex as well. And then really, how do you know what's important and what isn't? That's really a large issue. You can have all the best information in the world, but how do you filter that? So the impact that has on our decision making, we get analysis paralysis, an overwhelming amount of data competing for our thoughts, and then you end up really losing a key focus or a focus on anything. You just kind of give up, I think, and essentially you get overwhelmed, and that causes mental fatigue. So we want to avoid looking like this poor gentleman here staring at the screen. We don't want that fatigue. So how do we alleviate this and get around all this? Well, we need to prioritize, we need to be focused. And how about this? Automated data analysis and algorithms, I've highlighted that there. And then what about involving experts and specialists to help you along the way? So we're gonna look at 2 of those key points. So really, I think we can relate to this here, and we're gonna try to avoid that with what we're showing you today and how we do things. And how about time? It takes time to do anything well, and it takes a lot of discipline to screen watch. So if you want to screen watch and be a day trader, and if you're doing it successfully, that's fine. But not all of us have time to do this. We have our lives to lead and other jobs to do and responsibilities and family matters and so forth. And um, this doesn't always this isn't always that fun, as cool as it may look. It's not always that fun. So we just don't have time for that. The practical reality is a lot of day traders spend up to 10 hours a day in front of their screens, 4 to 5 hours a day actively trading. So we want to avoid that. I think we can all agree that's, for at least the vast majority of us, that's not practical. How about the third barrier would be just us, our own human emotions get in the way of our own success. Fear and greed tend to get in control of our decisions. We ride that emotional roller coaster. You get euphoric when things are going great and you feel pretty smart, and then they start going the wrong way, and then you capitulate, maybe wave that white flag of surrender, and then maybe you get back on track, headed the right direction, and you feel good again. But you want to get off of that roller coaster, and we need to learn how to control our emotions when it comes to trading. Then here's an interesting stat from just a couple years ago. JP Morgan estimates systematic trading accounts for 90% of US equity trading volume. And so essentially all the activity and volume out there isn't just individuals like us trying to decide when to buy something or when to sell something. It's obviously more advanced than that. So that's our competition. So automation, if you're not using it, I think you're doing it wrong. You're going to have to use some automation to be able to compete. So can we use option strategies and automation together? I think we can. And we're going to show you how we do it. And just a real brief review on options here. Remember, the buyer pays the premium and the seller collects that premium. So you can be a participant in an option transaction as a buyer or a seller. You can pay premium or you can collect premium. And if you pay the premium, you are a buyer and you're said to be long the option. And then the other side of that equation is who gets the money? Who gets the premium? Well, that's the seller. They're said to be short that option and they collect the premium. And of course, you can buy puts and calls or you can sell puts and calls. And for example, here's some typical long option strategies where you pay a premium. So in a bull market, you might just buy a call option and hope the market moves higher. Or in a bear market, you could simply buy a put option, hope the market moves lower. And either one of these cases, you're paying a premium if you buy a call or buy a put, and you need the market to move typically in a large degree in a short period of time for that to work for you. So that's a long option strategies where you pay premium. And then you have short option strategies where you're actually selling the puts and the calls. And there are non-directional strategies. You don't have to be bullish or bearish. Maybe you might project the market's going to be choppy, and there are strategies where you can use where you're trading options and you're selling options at this level here and at this level here, looking for the market to stay range bound. So you collect premium on the calls and the puts that you sell, and you look for the market to stay range bound. So we're going to look at how we do that. And then of course you can simply do short option strategies where you collect premium in a bull market. You might actually sell some puts, or in a bear market, you might sell some calls and collect the premium. So before we jump into the demo, we're going to look at a couple of Greek letters here. Delta helps us determine probabilities, and it is the value, essentially is how much does the option value change with the change in the underlying asset price. And option traders look at it as the approximate probability of expiring in the money. So that's how we're going to look at the delta. For example, a delta of 0.25, that means there's a 25% chance that option expires in the money. And conversely, there's a 75% chance it would expire worthless. And keep in mind, delta is a number that's always moving, it's fluctuating. You'll never have to calculate it yourself, but it's always moving with the underlying price and, of course, as time goes by. And it is not the probability of a winning trade. So I want to make that point clear as well. And then the other letter here is theta. So really, options are a wasting asset. They have limited life. And so how do you measure the time decay? And that's what theta represents: sensitivity to time, a negative number. It equals 1 day of time decay. And if that sounds kind of convoluted, actually it's very simple. When you look at it on a graph, essentially, as you approach time zero, the percent of the premium of that option drops and drops and drops because it's simply running out of time. It will expire. It will run out of life at some point, especially in the last 30 days here. And that's called theta decay. And just to give an idea of, in part, why we do what we do, here are 10 reasons why selling options can be better than buying options. And I just picked out a couple key ones here. Professionalism. Managing risk like a professional. The professional approach distinguishes option sellers from novice speculators. So we're going to talk about that. And then it talks about the strategy of selling options is often preferred by long-term investors who value consistency over high-risk speculation. And then I asked ChatGPT about selling options, and it says professionals sell options instead of buying. This is why. Time decay advantage. We talked about theta decay or time decay. Higher probability of profit because the seller receives the premium up front. How about this one? Market neutrality. There are strategies for sideways markets. So that's not something you often hear about. And how about market inefficiencies? Selling options can be a preferred strategy for many professionals. So just some key points there, even from AI, and they actually did a good job, very good summary there. But the Wall Street pros are trading option spreads to collect premium. And so what am I talking about, and what does that actually visually look like? Well, here is an out-of-the-money call spread. So you would sell this maybe if you were bearish or even somewhat neutral. So the red line here represents a call that you might sell, and you collect premium for selling that, and you put the money in your pocket, but you take some of that money and you buy a higher strike price call as a hedge or as protection. You don't want to be short a naked option, so we don't ever do naked strategies. And so here's what that might look like. You place this trade, you collect net premium here, and the market's moving around, going up and down, and then eventually here it expires there at that vertical line. So you end up, in this position here, probably doing well on that short option spread that you placed. Now, what about how do you know when to get out? Well, here's an example. You have this arrow right here and this line, this dot, this vertical line. And you can see here there's this blue box, and you notice there's 8 days till expiration on this spread that you sold. Well, this is a profit-taking signal, and we're going to show you in our software how that works. And this can be automated. So you get a profit-taking signal, and then it will automatically place an order for you to close out that position. And in this case, this is the day in which you first receive this profit-taking signal. So you're out of this trade before expiration. And in fact, if you follow all of the automation, you'll always be out of a trade before expiration. Now here's another example of a spread called an iron condor, another non-directional strategy. And really, you want the market to stay in this range. See these two black arrows here. You want to be below this red line and above this red line, generally speaking. That's how this works. So you can see in this case, the market kind of moved higher, down, and then, it eventually, that spread would eventually expire, but somewhere along the way, you probably get a signal to close out that position. So we're going to show you in just a second here in our demo. But that's an iron condor, kind of a fun name. And there's a reason why, but we're not going to get into it. Just the way it looks like on a graph when you graph the P&L. Okay, so There's another strategy called a dragonfly that we came up with this name a few years back, created this strategy for 6-leg non-directional strategy for premium collection. And it's a variation on the condor. And here's what it looks like. So you see your calls up here and your puts down here. And let me kind of just briefly explain here. The red line are the calls that you sell, and then you buy calls above and below as protection. And the red line here are the puts you sell, but you also buy puts above and below as protection. So for every short option, there is a long option. Again, this is a coverage strategy. So you place this trade like this. Here's what happens. The market's moving around, but the idea is that you intend to buy back the position for less money than what you originally received for it. So you sell the spread, or you go short the spread, and then as time works its way and the clock ticks off and the market's kind of chomping around, that theta decay works in your advantage. And you can see here, you get a signal here on this day on October 20. Here's that blue signal here that says take profits. There's 12 days left. You've made enough money on the position. So you've sold it. And then as time goes by, you simply buy it back later at a much lower price than what you originally sold it for. So you sold high and you bought low. And with trading, of course, you can obviously you want to buy something low and then sell it higher, or you can do that in reverse order. You can sell high and then buy low later. That's the idea. That's the intent, at least, for these spreads. But meanwhile, rookies are mostly doing this. It's a good little article from this reporter. And if you want to look at that on YouTube, you certainly could. But she says here, a majority of small-time traders are buying the most basic call and put options and have a much lower probability of profit versus advanced strategies like option spreads. So here's the CEO of Options AI says, everybody in the business knows that if you're only buying out of the money calls, you're likely going to lose money over time. So what they're really referring to is those are low probability outcomes. You have a potential for a lot of reward, but the possibility of that reward is very minimal. The probability of it is low, especially over a long period of time. Sort of like playing the lottery, I guess you could look at it that way. Yeah, there are some big winners, but the vast majority of people are not winning with that strategy. So we're going to look at professional option spreads, how to sell options and collect premium, and how we can manage this with the help of technology and algorithms. So our strategy in our software here is called ThetaTrader. These are pre-built strategies. We call them theta trades. And we use one-touch responsive trade alerts to help you along the way. These are bullish, bearish, or even non-directional strategies as well, as we mentioned briefly. And then we use the automation, something called the risk thermal indicator. And that helps with the profit and the risk. And then here's where we're going to jump into our demo. If you bear with me, and I'm going to switch screens. Let me make sure you are viewing the same thing I'm showing. Okay, good, you are. Okay, so here is the dashboard for ThetaTrader. And I'll explain, you can see up here, there's some trade alerts. I'll explain that in a second. And this is just a demo account for these types of presentations and webinars. So let's not make too much of the performance, whether it's good, bad, or one way or another. But I will show you the history of some of these trades. You can get an idea of what we've done in these demo accounts for these presentations at least. But here's open short positions, any open long or bought positions. And here's your account information over here on the right side. And that's, let me see if I can expand that, make that easier to see. This is integrated with your AltaVest trading account. So everything in ThetaTrader is integrated with your AltaVest brokerage account. So the first thing we can do is, why don't we look at today's theta trades? You notice there are bullish, bearish and neutral or non-directional strategies. And we're looking at three markets: the E-mini, S&P 500, NASDAQ 100, and the Russell 2000. And the short answer as to why we look at these three is because of volume and liquidity. This is where there's an enormous amount of trading activity, and we're able to get the execution on these spreads with minimal slippage in comparison to any other market. So this is where you really want to be trading. And then the other advantage, of course, to trading an index would be there's less volatility compared to an individual stock. Even your large cap stocks can move 20% in a day. So with that said, we will look at today here. We looked at the Condor and the Dragonfly just a minute ago. Let's look at a Condor on the Russell 2000. So this trade here has 44 days till expiration, and you're selling the 23.25 put and the 28.50 calls. It gives you your maximum profit potential on the trade, and this is your targeted annualized return here. Just kind of assuming you did this every 44 days for a year, but that's just kind of there to give you, I don't know, just another metric to look at. You certainly can't expect to do the same trade every 44 days and expect it to be a winner every single time. But here's what it looks like on a graph. So here's this Condor. You're selling this call 28.50. You buy a 28.75 as a hedge, and then you do the same type of structure. You sell a 23.25 put, and you buy one further out to cover yourself in the case of a market going the wrong way against you. So this is what it looks like on a graph. Here's the expiration date, and you can see the market chopping around, and here's where we are now. So for this to work, you basically want it to stay within this range between those red horizontal lines. And here are some of the details on the trade. And this is, again, the algorithm has already chosen this and built it for us. So there's 44 days till expiration, your put risk, call risk, commission, cash required, profit potential, targeted return on cash, targeted annualized return. And let me show you this here. The 23.25 put, the delta is 9.25. Then remember delta, and we looked at that. So this means there's over a 90% probability that this put that you're selling to someone else will expire out of the money in their hands. And then the same thing with this call, 6.25 delta. So over a 93% probability, according to the delta, that this call that you're selling to someone else will expire worthless in somebody else's hands. So that's why the algorithm is chosen to bring this one up and let you essentially sell it to somebody else and collect the premium. And you see the puts and the calls here that you're buying as additional protection. So you're trying to collect 2.35 points on the trade. You could adjust it up or down if you wanted. Quantity always defaults to 1 because you're just doing one spread. But if you want to go up or down, you certainly can. You can see the numbers changing. We'll go ahead and do just 7 of these. No reason why. You can see your cash required, 8,000, maximum profit potential, 675. And again, these are higher probability outcomes. So people will ask, well, why am I allocating 8,000 to make only 675? It seems sort of skewed the wrong way. Well, it's your higher probability outcome. The outcome of this happening is, according to the delta, highly in your favor as a person here selling this spread to someone else. So we'll go ahead and sell this here. And then it shows up as being filled in this demo account, selling those 7 positions, and it's just that simple. And then let me go back, and we can go ahead and look at a Dragonfly and kind of show you how that looks and compare it to a Condor. Then I'm going to show you some of these other features here as well. We have a really interesting, I guess you could say, well, it is proprietary and it's unique in the sense I've never seen anything like it in terms of a back testing machine or a time machine. But here is a dragonfly position. I'll go ahead and just do the Russell because we did one earlier with the condor, so we'll do a Russell here. So, and if you want to know, sometimes just point out too, sometimes here this Russell, for example, you only have one theta trade to choose from, but you notice on the S&P 500 mini, you have quite a few to trade from and choose from, I'm sorry, anywhere from 33 to 72 days till expiration. And that just changes according to the algorithm, deciding on which trade it, suits its model. So sometimes you can get 10 or 15 trades to look at for the day in terms of different expirations, depending on the market and the conditions. And other times you might just get one, like this one here. So we'll go ahead and look at this dragonfly. This has 44 days till expiration. And again, it's all pre-built, so you don't have to try to create your own spread. It would be very difficult to do, and I'll show you why with the dragonfly in particular. But a lot of the same data here. But you notice 22.49 is the cash required for a dragonfly in this particular case on the Russell, and your maximum profit potential is 251. And then you've got your targeted return on cash and targeted annualized return. But we'll go ahead and look at the puts and the calls. So the puts that are being sold have a delta of 12.9. So you've got like 87% probability that this put that's being sold would expire out of the money. And look at the call, about a 10% delta, so about a 90% probability that this call that's being sold to someone else will also expire out of the money. So you can change the quantity. You notice your numbers move up here or down. So you got about a $9,000 cash required and about a $1,000 maximum profit potential if you were to let that go till expiration. And we'll go ahead and just place that order, and just gives you a summary here of the order you placed for the day, and it's just that easy. Okay, so that's how simple it is to do a dragonfly and how simple it is to do a condor or any particular spread trade within ThetaTrader. Now what I'm going to do here, let me show you a couple of trade simulations that go back in time, and I want to compare performance, historical performance of a dragonfly trade versus a condor trade, and give you a couple of examples of why we really like the dragonfly. It's not to say we're not doing condor sometimes, but let's look at a condor. So there's a simulation here, and I'll show you how to get to this in just a second. But well, actually I can just show you now, but it's right up here under the trading. Let me just refresh that and go back to it in just a second. But for the moment, you can see November 13, here's a trade, an iron condor on the NASDAQ E-mini 100. So it's a week 3 December expiration, and we'll use these buttons here to go forward in time and backward in time. So anyone want to guess where this trade's going to end up? I'm not even sure I remember, and we'll see day by day, and we'll go forward. So you'll see the market starts to drop, and this RTI gets yellow, and that's okay. It's just a little bit of a caution that says risk is getting slightly elevated. You can see why, because the market immediately starts to drop. So it's getting closer to this lower boundary, and not enough theta decay has occurred yet. But then again, it just comes right back and it's green again. So do nothing. And then look at this. With 22 days remaining, you get a blue RTI, and that means take profits. So you can automate this so that when you get this blue RTI, your orders are automatically placed for you, and then you don't have to monitor and screen watch. That's what ThetaTrader is doing automatically for you. So typical example of an iron condor. And now here is a dragonfly. It's the same trade here, NASDAQ week 3. I think you get the same result with 22 days left. You get a profit taking signal. Yeah, same thing here. So that's just an example of how a typical iron condor and dragonfly might work. The idea is you sell it here, market moves around, theta decay works its magic, and then you close out the position. You buy it back for less money than what you originally received, and you move on to another trade. So we'll look at another condor. This is from October here. And even though the trade's a little negative at first, you still have a green RTI. So that's the secret. Just pay attention to the RTI. Then you get a blue RTI here, profit taking signal with 9 days remaining. So this worked out, this week 1 November expiration. Now let's look at the week 1 dragonfly. I think I know why this is here. I think there you go. So you get out with 15 days till expiration with this profit taking signal. Meanwhile, in the condor, you had to wait until there were 9 days till expiration to get out with a profit taking signal. So the advantage in this case with the dragonfly was an earlier exit, almost a week earlier. You have a profit taking signal to just close the trade out, take your money and run and go on to another trade. So your capital isn't tied up as long in the dragonfly in this particular big example here where you're comparing a condor to a dragonfly. And that can often happen in a dragonfly versus a condor. I guess that's the point I'm making. And that's kind of a benefit to having this structure here where you actually own this call and you own this put. It can sometimes be very helpful. And here's another example, I believe, of what I want to demonstrate where a condor may have a loss, but a dragonfly does not. So here we go. So yellow RTI, do nothing, but you can see, why it's getting closer to that upper boundary very quickly. Now an orange RTI, so even higher risk, but still do nothing. But now here, finally, a red RTI, too much risk, get out of the trade and take a loss. So this would be a losing trade with your iron condor. So let's look at, had you done a dragonfly instead, the end of month May expiration. Yeah, I've got it loaded here, end of month May expiration dragonfly. So you can see the condor was a losing trade with the red RTI. And again, that's automated. So you don't have to watch it and monitor. It would just place that order, close out the trade, and you would take your lump and move on. So again, you see the same market movement. You just happen to have a dragonfly trade instead of a condor. You get the yellow RTI, you got a lot of extra risk, and then the orange, even more elevated risk, but still do nothing. And then look what happens. Get a pullback here. And now theta decay is starting to work. And then you finally get a blue RTI here with a couple days remaining in that trade. So the dragonfly was a more robust position, more risk-averse position versus the condor. And it was just able to withstand this particular move that was against the position quickly versus the condor. The condor couldn't withstand it any further. It took a loss, but the dragonfly was able to hang on and eventually get out with a profit. So there are cases where the dragonfly will be more robust, more risk averse, but the trade-off is you're going to not have quite as much profit potential with a dragonfly versus a condor. So that's the trade-off. You have a little more risk aversion, but you don't tend to generate as much premium in return. So that's kind of how it works in life, right? Higher risk, higher reward, and lower risk and lower reward. All right, now let me show you, okay, let me do this first. Let me show you, here's another, here's how you get to the simulator right here under simulator, and you can go back in time, choose any year, date, month, and you can look at any trade and whether it was bullish or bearish or what have you. But I wanted to point out too that ThetaTrader does more than just non-directional. We just happen to look at the non-directional or neutral tab. Remember, there are bullish and bearish strategies here that are also pre-populated. So you could go back. I'm sorry, I'm jumping around. So if you were bullish, and actually we're kind of getting bullish depending on, based on a lot of the global macro research we follow, but there's a strategy called a bull hedge. And essentially it's a spread strategy where you sell an out of the money put spread, and you take that money and you buy an out of the money call spread. And you can often do that for even money. Sometimes it's called a combination, but you can see here there's trades available anywhere from 9 to 29 days till expiration on the S&P mini here. And here's a chart what it looks like. So again, you sell this out of the money put spread, you collect the premium for doing that, but you take that money and you use it to buy an out of the money call spread. And you can often do this for even money or sometimes even a credit. So the trade doesn't cost you anything. That's the beauty of it. And then you want to place that order. You can change the quantity, whatever you want. We'll go ahead and do 6 of these for kicks. And that's just how you do it. So just wanted to point that out. And now here is how you make the, here we go, the settings. You go under settings here, and this is how you automate everything. So here's a box here to check to activate risk manager. And you can use the default setting of 0.5, or you could lower it to 0.38, or you could customize it 0.5 to 0.25. And it's okay if you want to do this, but keep in mind, if you had a 0.25 risk level here, you will take more frequent losing trades, but the magnitude of the losses will be smaller. So if that's more comfortable for you, you can certainly do that. Or say the orange, same thing applies here versus the 50. But I use the 50, and we kind of base all the simulations on 50. And then you would just save your settings. And now if you want to activate your profit directive, which I would highly recommend you do as well, you just click that box and then you save your settings. And then that's all you have to do there. So once you do that, that's automated. So everything is now automated in terms of managing your position, just like we saw in those examples. So that's how that works in the settings. Also want to point out, there's a, under my account, you've got this help file. You have all the details here on the color coding and how it works. You have all the definitions here on all the spreads. But more importantly, or as important, I should say, these are all video tutorials here. So these are just 2 or 3 minute tutorials on placing an order on a condor or selling a spread or a dragonfly or whatever you want to do. These are just little tutorials. And there's also education on futures and options. So actually we put this together just recently, and this is going to take probably 10 to 12 minutes for each chapter. So you don't have to sit here for 8 hours of training on each chapter. We just going to review what is important to know, and it's all right here. These are short video educational chapters here. So you're going to want to look at this as well if you need just a review or a refresher, on essentially the ins and outs of options trading and some of the more advanced strategies such as we're looking at here today. And then of course, let me show you a couple other things. Let me go back to the dashboard here. But before I do that, when you go to the dashboard, you'll notice you can see all of your open positions that are short or your short spreads, and all of your open long or bought positions. So that's right on your dashboard. But you can also go back and you can look at your positions that were closed. So you can see your closed history here. Let's see here. Oops. Here we go. So you can filter by any strategy that you might want to look at or any date range. It shows 20 closed positions at a time. Now you can see on this page you've got 20 trades, so 18 winners, 2 losers, and here's your total profit here. Now, 17 of those positions were short option strategies. And of that, 15 of the 17 were winning trades and 2 were losers. And then you had 3 bought or long positions, and you had 3 winners and 0 losers. And that's kind of uncommon, but again, this is just a demo account. Don't make too much of the performance. I guess what I wanted to show, just a second, folks. I guess what I want to point out here is, let me go to the next page. Let's see if it kind of highlights what I want to show. Yeah, this is kind of, I guess, more in line with what I'm getting at. You'll see you bought 4 positions, you paid premium, but 0 were winners. And those are the blue ones. You can see each time you just paid premium and bought the option spread, in this case, you lost money. So those are the lower probability outcome trades. That's kind of what we're talking about. So you can go to the next page here. And again, you've got 17 trades on this page. 12 were short option strategies. So 11 of those were winners. Only 1 was a loser. And you had a couple winners here, a few winners in the long option strategies. But ultimately, just wanted to kind of show the ratio of short option strategies versus long option strategies, and how, for the most part, in most environments, the vast majority of trading environments, your short option strategies are going to be preferable versus a long option strategy. And you might want to look at just a dragonfly. You could do that here. So you can see here you've got just sorting by dragonfly. You can see all the dragonflies here turned out to be good trades. But again, we're in a good environment right now for these positions, even though the market's at highs and rallying. As you see, there's a lot of margin of error on these strategies. The dragonfly, for example, we looked at, well, here, we'll look at another one. This has 72 days till expiration, and it's on the E-mini S&P 500. You can see the strike prices here, 6,200 puts being sold and 75 calls being sold. And the expiration there is for March week 3. Trying to collect, let me look at the graph. So yeah, you can see the wide margin of error here. So you get these ups and downs, and the bias might be higher in the last few months, and it could still move higher, and a dragonfly trade will still do fine. It won't work if you get a move like this or a move like that. So in a matter of days or something. All right, now here is what I wanted to show you. You'll notice something here. Let me expand this just a bit. You'll notice we have some trade alerts. These are active trade alerts that were just sent today. And let me pull those up for us here. So here's the first one. This is a dragonfly. So the March week 3 dragonfly. And what we did on this alert compared to the ThetaTrader or the model is we shifted up the call and put strikes a little bit higher. We bumped up the call strikes, all the calls a little higher, and we bumped up all the put strikes a little bit higher. And that just reflects a slightly bullish bias in Q1 of this year. And the reason we do that, of course, is it gives you more room or more margin of error here. So the trade could still move higher and higher and higher, and this position would still work out just fine. Now let's point out here, this alert was sent to me in my demo account, and the quantity of 9, and where does that come from? Well, this is all integrated with your AltaVest trading account. So the quantities are pre-selected for you in your account. Every trade you receive is customized to you and your account based on quantity and strategy. And it looks at basically the available cash in your account, other positions in your account, how much exposure you have, and it gives you a appropriate quantity. Now you could change it by lowering it, but you could not add to the quantity and increase your risk and exposure. So I'll just go ahead for kicks and go to 8. And you can see here, you're trying to collect 24.48. Here's the margin required. You have 72 days till expiration. So everything you need to know about this position and this trade here is for you right here on the trade alert, right on your dashboard. And if you want to accept that trade, you just touch accept. And that's all you have to do. And then here's another alert. So here is a bullish S&P 500 spread, selling the puts to finance the long call spreads for even money. So we just looked at that actually, the bull hedge. So here's the market price now. So you're selling this out of the money put spread here, and you're buying an out of the money call spread, and hoping for the market to make a nice move higher in a relatively short period of time. You've got only 9 days till expiration. And if it doesn't, if it just happens to chop around and go sideways, it really wouldn't matter because you're doing this for almost even money. And when I say it doesn't matter, in the sense that you wouldn't stand to really lose or gain anything if the market here from here just kind of went sideways and the trade expired. But you do have potential to make good money if you get a sharp rally. And of course, if it sharply declined, you'd have to follow the RTI on this short put spread and then cover the risk there. All right, so maybe we'll do, just to be different, we'll do 9 of these. Well, why not? Why not do 10? We'll just do the recommended 10 and we'll go ahead and accept it. But this is, again, this would be the bull hedge strategy. You know, of course, it doesn't have to be 9 days till expiration. You could find trades that have much further days till expiration. Some people ask, do you do 0 DTE? No, we do not. That's too aggressive for us. And I think that you're going to want to be slow and steady to win the race rather than that aggressive. But in any case, we'll go ahead and accept that. And just that simple. So now let me show you, let me go back here and let me show you, I think, what might be the best feature of all in terms of the trade alerts. Let me change my screen. I see some questions, so keep them going here. Keep them coming. I'll get to your answers here. I see a few questions already. Thanks, folks. All right, so I want to make sure you're looking at the correct screen. Yep, we're good. All right, so here is really, I think, the best part of the trade alerts. It's the functionality you get when they come directly to your phone. So you just saw how it works on the dashboard, which is fine if you're looking at the dashboard. But part of the beauty of ThetaTrader is you don't even often really need to probably use the dashboard if you're going to place a trade, because we send them right to your phone. So again, these alerts are live. They're integrated with your AltaVest trading account. So you simply touch accept and you place that order. So here's what it looks like. You'll get a text message with a link. We'll go ahead and show you here. And you'll touch that link and it takes you to the alert page. So this should look somewhat familiar. So this happens to be a dragonfly with 66 days till expiration. See the current trading price. You'll see your vertical line there for the expiration. So these are the puts, these are the calls that are being sold and bought. You've got a pre-quantity there selected of 7. You're trying to enter at 9.6 or higher. And you could always adjust that lower if you wanted. We saw how to do that. In this case, I would just happen to go to 5 just to illustrate, trying to collect almost $2,000. And you go ahead and just touch accept. And once you touch accept, the beautiful wizardry of the AltaVest technology and ThetaTrader handles everything for you. So then once that trade is filled, if assuming it is filled, you can then have the RTI automatically monitor that and manage that position for you. So it's really, really user-friendly and convenient. People love using these alerts. And I guess we probably don't need to see that again. So if you want to get started using ThetaTrader, and why wouldn't you if you're an options trader, You get the theta trades, you get the risk thermal indicator, and the trade simulator for back testing. So everything we just saw, all part of ThetaTrader. That value is $3,588, the retail value on the ThetaTrader technology. And then it also includes the trade alerts. So keep in mind, these alerts are integrated with your account. That's what makes them so powerful. You don't have to log into another third-party platform and try to copy an alert, because I know how alerts are now. You'll receive them via email or text, and you'll have to copy and transpose them into another platform somewhere else. You don't have to do that here. You just touch accept or reject, and then everything is automated once your order is then filled, if you have the RTI set up to automate things for you. So that value of over $4,400. So again, ThetaTrader includes everything you've seen plus the trade alerts, valued at over $8,000, but it also includes us, private coaching. Here we are at a live event a few months back in Miami. So that was a lot of fun. So we are all licensed and experienced, and we'll set up screen sharing sessions with you, kind of be your guide. And how much is it worth to you to have a coach, someone who's experienced and licensed? Well, comprehensive packages here for mentors typically range from $5,000 to $15,000 over a 6 to 12 month period. That's for private trading coaching. So I think it's very valuable. I think you do too. That's probably why you're in part listening, is trying to learn. I think we're always learning every day, but this knowledge really is priceless. You get a co-pilot. We're all licensed. We'll help you discuss strategy, review your trades. Let's assign a value of 10,000, kind of meet in the middle on that other page we just looked at. But even then, I think that's probably undervalued. But you get ThetaTrader with the alerts, the private coaching, a value of over $18,000. And then this corny, bonus, right? There's always more, but I didn't review it, but we have daily research as well as part of ThetaTrader in our TradeScope newsletter. It's just 1 or 2 pages. It's very short and to the point, and it gives our bias in terms of whether bullish, bearish, or neutral. So you can read as to why we are thinking what we're thinking. And then remember, I mentioned the education in ThetaTrader too, those chapters. So you'll get everything you need here. I think there's 6 or 7 there. So that masterclass education, that's all part of the ThetaTrader membership as well. $1,997 with TradeScope. That's our research and our education. And that's all proprietary to us. And then you had those video tutorials. That's all part of ThetaTrader as well. So just to summarize, ThetaTrader software and the alerts and the private coaching and the research and education, valued at over $21,000. So that's our total professional package. Of course, we're not offering it at that price because these are special live events. We used to do this in person at seminars for this price here, $4,000. And then our retail price, $997. So we're going to do much better than that. And this is just a one-time payment, folks, and this is lifetime. That's what that means. One-time, lifetime. $597. Here is the link, cf.altivest.com/TT, or just take a screenshot of the QR code. Do save our name. That's my name and number there, email, I should say, my direct line. If you have any questions or comments, love to hear from you. I'll leave this up for a second, but take a picture of that, copy that, or go just directly to the order form page. It's just a simple 1 page. And now if you want a free membership, you sign up with us, and if you start trading in the next 30 days, we'll rebate you 100% if you have 100,000 or more, or 50% if you have 50,000 and above. So that's a great offer. People love to take advantage of that as well. And really, you have no excuse, because, as you might expect, we offer a 30-day guarantee. So if you sign up, you decide to no longer pursue it, that's fine. We'll just refund your membership. Very simple, no more to say on that. And just to summarize a few advantages on the E-minis. Of course, they're affordable, so they require less capital. There's flexibility because of all the strike price availability. They're very liquid, so you can expand your trading strategies. And that's what we're doing with these dragonflies, for example. And really, we're doing the E-minis in part too because you don't need to choose 6,000 different tickers and securities and filter. We're just trading the major stock indexes. You know, you got 3 tickers to look at on ThetaTrader. And why wouldn't you? Look at this. The E-mini S&P 500 futures market is 2.5 times larger than all of the global ETFs in terms of its average daily dollar volume. So this is where the activity is occurring, folks, if you didn't know it. Options here, 1.5 million average daily volume in the E-minis, and that's from last year, 2024. I need to get the 2025 data. I'm gonna have to look that up. And the CME group says they offer superior execution, and it's kind of hard to argue against them. They offer a cost savings of $4 to $15 per contract versus the SPX options. And what that really means is you get the tighter bid offer spread on that. For every option you're trading, you want the best execution possible. So that's a big benefit to trading the E-minis. Remember too, we're only doing covered option spreads, so no unlimited risk, no margin calls. That's a big deal. You don't want margin calls forcing you out. There's also no pattern day trading restrictions. So if you're familiar with that, and if you're not, briefly, the pattern day traders, you're subject to additional regulatory scrutiny and limitations. And if your account falls below 25,000, you're prohibited from making further day trades until you bring your balance back above 25,000. So when you're trading in securities, you have these different regulatory issues to contend with. You don't have that. That does not apply to trading with us with futures options. Big advantage too is tax efficiency. All futures and options are tax efficient, so they can lower your tax rate, and that can essentially, the IRS treats your gains differently with futures. So 60% of the gains are taxed at the capital gains rate, and 40% are taxed at your personal rate. So here's a mathematical example. Won't go into the details, but trading futures, versus an individual stock, for example, you're going to have some tax savings for sure due to that tax efficiency. And another advantage, there's no more itemizing each trade. You just receive your 1099 with your profit at the end of the year when you're trading futures, and that's all you need. You don't have wash sales or itemization for every transaction. You don't want to end up like this guy here. So that's a big another big example of the benefits. So, but always consult your tax attorney or not advisor, I should say, on those issues. And here's something too, you can do a self-directed IRA, and we work with Equity Trust. So they have 71 billion under assets, under custody, I should say. So, and they will set up, the setup fee will be waived for AltaVest. So you want to start using ThetaTrader, you open an account with us, and then you want to trade with your self-directed IRA and work with Equity Trust as your custodian, then they will waive your setup fee. So that's a great deal. We did a presentation with them a few months back. That was a lot of fun. And then also, I just want to point out, we're full service. We can trade any futures options market. You see kind of here, metals, corn, gold, corn, currencies, whatever. And here's a little chart I put in here. We had a presentation over a year ago on gold and silver, and we did one just another couple months ago. We've been kind of pounding the table on that one for a year, but look here, S&P 500, the black bars here, up 18% in a year. That's great. Gold up 65%. See the gold, silver up 150%, and we don't think the run is over. So if you want to talk to us about that or any other commodity market, that's fine too. But primarily, we wanted to talk about ThetaTrader and options trading today. So just to summarize, flexible strategies for any market condition, up, down, or sideways. Professional premium collection strategies. So we've simplified them If you want to do a dragonfly on a individual stock, you really can't do it in one order like we can with the E-minis. We built this proprietary technology to be able to do that. I've got all sorts of other brokerage accounts and other people I know too. And I've looked around and I don't know of any other platform that can do a 6-legged spread as one order at one price. Big advantage here. And convenience with the automation. You can diversify your existing portfolio or even hedge. And you've got that tax efficiency, tax advantaged aspect to trading with us. And then you have those one-touch responsive trade alerts, and then of course no day trading restrictions. So as he says here, that's a lot of information. Got any questions? So let me see. I'll leave this up here. And this expires, the 597 offer expires, I believe, tomorrow night. So you've got some time to think on it, but really it's a 30-day guarantee anyway. So if you want to get signed up, we'd love to have you on board. Let's see here. No, there's no cost. Someone asked about the cost for trade alerts. There's no cost for the trade alerts. It's just part of your ThetaTrader membership. And then someone's asking about maximum risk. Well, the maximum risk on any trade is all pre-calculated based on the strike prices of a particular trade and the spread. So if you've got a spread, a typical condor might have a 20-point spread between the short strike and the long strike on the E-mini S&P 500. So that would be $1,000 on a particular condor just per one lot. So if that answers part of the question. Trading account size. Each dragonfly, the margin is about $5,000 on a S&P 500. So you kind of take that, and I would suggest, we suggest 25,000 and up, but the bare minimum is 10, I would say. And you might want to do condors. You know, if you had a dragonfly on the S&P 500 mini and you only had $10,000 account, then you've got half of your account allocated to just one trade. So that's a pretty large concentration in just one particular trade. So you might want to look at some of the different strategies that have smaller margin requirements, if that makes sense. Let's see, anything else, folks? I always get questions about Canada. Unfortunately, there's some parts of Canada we can't work with, but let me know. Just email me or let's see here. I can go back. Let's see, where's my email? Didn't I have my email up here? It's back there somewhere. But anyway, it's Eric, E-R-I-K, at altavest.com. And let me know what your situation is. Let's see, anything else? I don't see any other questions, but yeah, those are good questions. Let me put my information in the chat here. All right, folks. Thanks for joining us, and that's going to wrap it up. Hope to see you on board with us shortly, and we'll get you onboarded and get your questions answered. But ThetaTrader is very intuitive and user-friendly. You saw it's very, very simplified versus many other platforms, and that's the whole idea behind it. You have access to these institutional strategies, really, that the professionals are using, and that most retail traders are probably, well, they're just not using them. So anyway, thanks for joining me, and hope to hear from you shortly and see you come on board. Have a great rest of the day.